Your phone buzzes with bad news. The stock market just dropped 10%, maybe 20%. Your savings look much smaller on the screen. Friends are texting, sell everything. The TV screams, crisis. Your heart races. You feel like you have to do something, anything to stop the bleeding. But what if I told you that doing nothing is often the bravest, smartest thing you can do? That one sentence changed how millions invest. Don't just do something, stand there. Over the next half hour or more, I'm going to explain in plain words why this advice has protected people's money for decades, why most folks get it wrong, and exactly how you can train yourself to stay calm when the world feels like it's falling apart. Let's begin. My friends, let's start with the most important truth of all. The stock market is emotional. It's not just numbers on a screen, it plays with your feelings. When prices go up fast, you feel smart, excited, unstoppable. When they fall hard, you feel afraid, stupid, helpless. That fear is powerful. It pushes you to act fast. I've seen this fear destroy good plans over and over in my 65-plus years watching markets. Back when I was young, in the late 1920s and early 1930s, the Great Depression hit. Stocks fell nearly 90% from their highest point. Families who had saved for years watched it vanish. Many couldn't take the pain. They sold everything at rock-bottom prices. They thought they were protecting what was left. Instead, they locked in huge losses forever. Years later, when the market finally recovered, those people were left behind. Fast forward to my own working life, the 19th of October, 1987, Black Monday. The Dow Jones dropped 508 points, 22.6% in one single day. That was the biggest percentage drop in history up to then. People panicked. Brokers' phones rang nonstop. Investors sold in waves. Many never bought back in because they were too scared. But within about 2 years, the market had climbed all the way back and then kept going higher for most of the 1990s. Then the year 2000 arrived, the dot-com bubble. Internet companies with no profits had stock prices going through the roof. Everyone talked about getting rich quick. When the bubble popped, those stocks fell 70-90%. The broader market dropped almost 50% between 2000 and 2002. Again, fear ruled. People sold their funds, moved to cash or safe things, and missed one of the strongest recoveries ever. The crisis I remember most clearly is 2007, 2009. The housing bubble burst, banks almost collapsed, millions lost jobs and homes, the stock market fell more than 50%. It felt like the end of the world. Headlines said depression was coming back. Many investors sold at the lowest points March 2009 and swore they'd never trust stocks again. But starting that very month, March 2009, the market began one of the longest upward climbs in history. By 2013, it had recovered everything lost. By 2020, it had more than quadrupled from the bottom. Those who held simple, low-cost index funds saw their money grow enormously. Early 2020 brought the COVID crash. In just 23 trading days, the market fell 34%. Businesses shut down. People worried about everything, health, jobs, life itself. Selling felt like the only safe choice. Yet the recovery was one of the fastest ever. Stocks hit new highs by August 2020, less than 6 months later. In 2022, inflation spiked, interest rates rose quickly, stocks dropped about 25%, fear returned. Many thought a big recession was coming. But again, patience won. The market recovered in 2023 and kept climbing. Every one of these stories shares the same mistake. People felt they had to do something. Sell now, move to cash, chase, safer investments. But doing something in panic usually means selling low and buying high later if they buy back at all. Why is panic so strong? Our brains are built to survive danger. In ancient times, running from a lion saved your life. Today, a falling stock chart feels like danger. Losing money hurts twice as much emotionally as gaining the same amount feels good. Scientists call this loss aversion. It makes us act fast to stop the pain even when acting hurts us more in the long run. Let me give you a clear example anyone can understand. Imagine you put $10,000 into a low-cost stock market index fund that owns pieces of thousands of companies. One day the market falls 30%. Your $10,000 is now $7,000. You feel terrible, like you failed. So you sell to stop the bleeding. You take the $7,000 and put it in a bank account earning almost nothing. A year or two later, the market recovers and goes higher. Your friends who did nothing now have $14,000, maybe $18,000 or more. You still have roughly $7,000 plus a tiny bit of interest. You didn't just lose $3,000 in the drop, you lost all the future growth on that money. That lost growth can be tens or hundreds of thousands over a lifetime. Real studies back this up. A company called Dalbar has tracked what actual investors earn compared to the market for many years. The gap is shocking. Average stock fund investors often earn 4-6% less per year than the market itself. The reason? They buy when everything looks wonderful, prices high, and sell when everything looks terrible, prices low. They follow their emotions instead of a plan. Another way to think about it, investing is like planting an apple tree for your grandchildren. You put the seed in the ground, you water it. You don't dig it up every month to see if it's growing. That kills it. You leave it alone, storms come, droughts come. But if you wait long enough, it grows tall and gives fruit for years. The stock market works the same way. Your money is the seed. Time and patience are the water and sun. Crashes are storms. If you keep digging it up in fear, you never get the fruit. So today's first big lesson is simple but powerful. Panic feels urgent, but it almost always hurts you. When fear hits hard, that's exactly when you need to remember my words. Don't just do something, stand there. Now let's turn to the bright side. While fear pushes you to act and lose, patience lets your money work quietly and powerfully for you. The most important friend you have in investing is time. The longer your money stays invested, the more it can grow. This happens because of something called compounding, and it's easier to understand than most people think. Compounding means your money earns a return, and then that return earns more return, and then that earns even more. It builds on itself like a snowball rolling down a hill, small at first, huge later. Here are easy numbers to see it. Suppose the stock market grows about 7% per year on average after inflation, a fair long-term number based on 100 plus years of history. Start with $5,000 at age 20. After 10 years is approximately equal to $9,837. After 20 years, age 40 is approximately equal to $19,348. After 30 years, age 50 is approximately equal to $38,061. After 40 years, age 60 is approximately equal to $74,872. After 50 years, age 70 is approximately equal to $147,268. Notice something important? The first 20 years roughly doubled your money twice, but the next 20 years doubled it again and more. Most of the real growth happens later because the base gets bigger every year. Now make it even better. Add regular saving like $100 every month from your allowance, job, or side hustle. At 7% growth, after 40 years, that could turn into over $250,000, $300,000, depending on exact numbers. That's real money for retirement, a house, helping family, all from steady, boring patience. But here's the catch. You only capture this magic if you leave the money alone. If you pull it out during a scary drop, you stop the snowball. You lose all the future growth that money would have earned. Patience also means you stop trying to guess the perfect moment to buy or sell. People call this timing the market. They say things like, I'll wait until it drops more before I buy, or I'll sell now before it falls further. It sounds clever, but almost nobody can do it reliably. Professional money managers with huge teams, computers, and research can't do it consistently either. Reports from S&P Dow Jones indices, called SPIVA reports, show the truth year after year. Over 10-15 years, 80-95% of active fund managers fail to beat a simple, low-cost index fund that just holds the market. Over 20-30 years, the number gets even closer to 100% failure. Why is timing so hard? Short-term prices jump around because of news, rumors, politics, weather, new inventions, even social media posts. These things are impossible to predict perfectly. But over long periods, 10, 20, 30 years, stock prices follow something steady. Company profits. Businesses make things people want. They earn money. They pay dividends. Profits grow as the economy grows. Prices eventually follow. So the winning strategy is not guessing the short-term direction. It's staying invested for the long term. A real-life example. In the late 1990s, many people tried to time the tech boom. They bought when prices were crazy high. When the crash came in 2000, 2002, they sold in fear. Those who simply owned a broad index fund and held through the pain did far better over the following 15, 20 years. Another example. After the 2008, 2009 bottom, many waited for the perfect time to get back in. They missed the huge rally that started immediately. The single best days in the market often come right after the worst days. If you're out because of fear, you miss the biggest rewards. One study looked at the S&P 500 over 30 years. If you were fully invested the whole time, you got the full return. But if you missed just the 10 best single days out of thousands, your ending amount was cut roughly in half. Those best days usually happened during scary periods when most people were selling. Patience means turning down the noise. Don't watch your account every day. It will go up and down a lot. Check once or twice a year. Avoid financial TV or apps during wild times. They make fear stronger. Focus on your simple plan. Save regularly. Own the whole market cheaply. Hold on. This isn't thrilling like gambling or chasing hot stocks. There are no exciting stories to tell friends. But in investing, boring usually wins. As I've said many times, the stock market is a giant distraction to the business of investing. The real business is owning productive companies for a long, long time. Let's look straight at the record. Markets crash. They recover. Every single time if you wait. The worst crash ever. 1,929, 193, two Great Depression. Stocks fell 89% peak to trough. Unemployment hit 25%. Banks closed. Many people sold everything and gave up on stocks forever. But if someone had held a diversified stock portfolio from 1,929 through the 1950s, they would have seen full recovery and strong gains afterward. It took about 25 years, but the economy rebuilt, companies innovated, and stocks followed. 1,973, 1,974. Bear market stocks down 48%, high inflation, oil crisis, Watergate scandal. Many thought capitalism was broken. Recovery took a few years, but the 1980s became one of the greatest bull markets ever. Black Monday, 1,987, 22.6% drop in one day. Pure panic. Full recovery in under 2 years. Dot-com bust 2000, 2002. Broad market down 49%. Tech stocks down much worse. People called the internet a bubble that would never recover. Yet internet companies changed the world, and stocks hit new highs by 2007. Global financial crisis 2007, 2009, down 57%, felt like the end. Governments saved banks. Many investors sold at the March 2009 low and never returned. But that exact low point started the longest bull market on record, up over 400% by early 2020. COVID crash, March 2020. 34% drop in weeks. World shut down. Fastest recovery ever knew. All-time highs by summer 2020. 2022 bear, down 25% amid rising rates and inflation fears. Recovery began in 2023 and continued strongly. What do you see in every case? The bottom felt like the end of the world. Fear was maximum. Selling was everywhere. Recovery always followed, sometimes fast, sometimes slow. Those who sold low missed the biggest part of the rise. Those who stood there, especially with low-cost, broad index funds, were rewarded. Why do recoveries keep happening? Simple. The world doesn't stop. Companies keep inventing, producing, selling. People keep working, buying, improving. Economies grow over decades. Profits grow, dividends grow. Stock prices eventually reflect that growth. Diversification is key here. If you own only one stock or one industry, like tech in 2000, a crash in that area can hurt badly or wipe you out. But a total market index fund owns thousands of companies in every sector. When some struggle, others do well. The overall market keeps moving upward over long periods. I spoke with many investors during these tough times. Letters, calls, conversations at conferences. They asked, Jack, is this different? Should I sell? My answer was always calm and the same. If your investments are low cost, broadly diversified, and matched to your long time horizon, no, don't sell. Stay the course. Most who listened came through stronger. The ones who didn't listen often bought back later at much higher prices. They paid more for the same things they sold cheaply. History's message is clear and consistent. Crashes are temporary tests. Patience is the passing grade. Time turns paper losses into real gains. My friends, knowing why you should stand there is one thing. Doing it when fear hits is another. Here's how to build the habit step by step. Step 1. Build your simple plan before trouble starts. Decide your basic mix. Young people, 20 seconds, 30 seconds, can handle more stocks, maybe 80, 100% in a total stock market index fund for growth. As you get older, 40 seconds, 50 seconds. Add bonds for steadiness, perhaps 60, 70% stocks, 30, 40% bonds. Use 1 or 2 low-cost index funds. That's all you need. Write the plan down. Look at it when emotions run high. Step 2, make saving automatic. Set up a monthly transfer from your bank or paycheck, $50, $100, $200, whatever you can afford. This is dollar cost averaging. When prices are low, scary times, you automatically buy more shares. When high, you buy fewer. It removes emotion from buying. Step 3, reduce temptation to look. Don't open your account app every day. Hide the apps or log out. Check balances only once or twice a year, maybe on your birthday or New Year's. During crashes, avoid financial news channels, social media investing groups, and hot tip apps. They feed fear. Step 4, anchor yourself to your real goals. Why are you investing? A comfortable retirement so you can travel? Helping your parents or kids? Buying a home without stress? When fear hits, close your eyes and picture that goal. A temporary drop in numbers doesn't change the long-term picture. Step 5, strengthen your mind. Read simple books that explain these ideas. My little book of common sense investing is short and clear. Listen to calm voices, not hype. Join friendly online communities like the Bogleheads Forum. People there remind each other to stay calm during storms. Step 6, learn from mistakes, mine included. Early in my career, I got pulled into complicated funds that promised big wins. I learned the hard way. Simple and cheap almost always beats clever and expensive. My biggest lesson? Stay humble. No one knows exactly what will happen tomorrow. Trust history, math, and patience instead. For young people especially, and I know many of you are watching, start right now, even tiny amounts. $25 or $50 a month at age 18 or 20 can grow to hundreds of thousands by retirement because time is on your side. Waiting 10 years means you need to save much more to catch up. Your action steps today, do these this week. Open an account at a low-cost provider, Vanguard, Fidelity, or a similar trustworthy place in USA or wherever you are. Choose a total stock market index fund or global if you want worldwide exposure. Set up automatic monthly deposits, even small ones. Write one sentence. I promise myself I will not sell in panic. I will stand there. When the next drop comes, come back to this video or my books. Read the history section again. Breathe. Wait. This habit grows stronger every time you practice it. Each crash you survive makes the next one easier. You start to trust that time really does heal market wounds. Thank you for listening all the way through. This is day 2 of our 50-day series on my ideas. Tomorrow we'll talk about the one core principle that guided everything I did in my life. Until then, when fear knocks, don't just do something. Stand there. Be patient. Trust time. You are building something real and lasting. God bless you, and stay the course.